The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.
Welcome to Honest Money. I'm Warren Ingram.
I'm Pieter Villiers from Money Marks.
Pieter has asked me to do a special shout out to one of our viewers, I guess, because he's commenting. He likes our new setup, which we've done a little while ago. And then he didn't like the fact that we didn't have any decorations. I won't use the exact words that he used, but he just said that we could spruce up our decorating a bit. So there you go. I hope you like the painting. We didn't buy it for the show, but we don't have that kind of budget. But yeah, so thank you for the comments. Thank you for engaging. We appreciate it, and please keep sending the comments. Less decorating, more investing would be helpful.
Yeah, thank you, Andries. We've got our ladies' touch over here, so we hope that you approve. You let us know. We're building as we go, but I think it adds a nice little touch to our setup. But if there's any other suggestions, I know in our initial videos had cables all over the place. That was my fault. So now we got our little basket here as well. So every time I hope you guys notice, there's a little bit of an upgrade.
We're upping our game
as we reflect back and refine.
So today's a topic that's dear to both of us, dear to our hearts around fees. And I think, just getting into that. So I just wanted you to kick off maybe and just let's sketch out the show.
Yeah. And we talk about fees a lot because if we look at how we build wealth, there's a lot of things that we can control and there's a lot of things that we can't. We can't control markets. Markets are going to do whatever they want to. What we can control is the way we invest our money, where we put it, the funds we choose, and who we choose to help us. And that evidently, if you make use of a service, you're going to pay a fee. So what we're going to discuss today is actually now, okay, so let's dig deep into what are the types of investment fees that you typically would pay, and then our opinions on what is reasonable as opposed to the service that you'll receive. And I'm going to start off maybe by saying there's no such thing as free. If something is free, then either you are the product or you're going to pay a hell of a lot of time fixing problems that could have been prevented for this free. So I think before we dive into what the fees are, just understand that if something is free, I'll be cautioned because there's usually some other way that someone's going to make money off of you. And I would actually avoid that entirely, or at least to have a good understanding of, okay, but how are you guys making money? Because no one's running a charity, and as hard as we all work, we all want to be compensated. So just start with that. But also equally, we don't want you to pay unreasonably high fees for stuff that might not be in your best interest.
Yeah.
So how do we know what fees do we pay? If you ever look at your investment, there's probably a lot of statements that you'll find. But the easiest way to really see all the fees that you pay, and I have to give a shout out to the South African finance industry that has actually implemented that rule that fund managers have to provide what is called an effective annual cost, EAC statement that you can request from your provider, whoever you are invested with. On that statement, you'll see four fees. There's investment management fee, there's a financial advisor fee, there's an admin fee, and then there's a other fee. Now, I think let's cover each one of those different levels of fees. In starting off with investment management fee, that's easy. That's the fund that you choose to invest in. Now, behind the fund, if you buy a fund, there's no ETF or unit trust, there's someone sitting there and choosing what type of asset classes or what type of companies or regions do we add to that fund. And there's also costs involved with managing the fund. There's custody fees of keeping the money safe. There's transaction fees of buying and selling. And that all of those fees are included in the managing the fund. Now you get low cost funds, typically your index funds, which is just like, it's mostly automated. It's tracking a specific index. It's a computerized program. If the markets do well, your index goes up. If it does badly, your index goes down. The lowest fee that I've ever seen on passive low-cost ETFs are like US-based ETFs. I think it is maybe the VOO, I think is the ticker symbol. It's the S&P 500 of Vanguard, 0.03%.
0.03.
That's the lowest that I've seen. Maybe there's something else, but that's like the lowest low. And because they can do that, it's a massive fund, it's a massive economy. a lot of investors in that fund, so that they have economies of scale. So that's kind of the lowest I've seen that you can go. But then you also get actively managed funds, which means that there's a fund manager that looks at the markets and they see where the economies are moving, and they try and maybe buy companies that are valued at a lower level than more expensive ones. So they bring in a little bit more of risk management into the portfolio. But these guys are highly qualified, typically chartered financial analysts, CFAs, that sits there and they monitor the markets and they choose the companies that they think would perform well. And they need to draw a salary. So typically actively managed funds are more expensive. I'm not sure what the highest on that is. I don't have that number, but it can go from 1%, 2%, sometimes 3%, which is considered quite expensive. And then included in that is a performance fee, which some fund managers, if they beat a certain benchmark in a specific time period, they will have an extra fee that will be added to kind of reward them for that performance that they've achieved. So that's my understanding around investment management fees. So if you have,
maybe we just got to give a bit of context to index tracking costs in South Africa, because I can just imagine someone's watching this and they're looking at their South African top 40 or top 50 index going, hang on, I'm not paying 0.003 or whatever it is, and I'm getting ripped off because I'm paying 0.4.
Yeah.
And so just to say that, I mean, I think if you're tracking an index in South Africa, paying a cost of around about 0.4, 0.3, 0.4 to me is a very good fee. If you've got an index tracking product that's charging you 1.5% a year, you're probably getting ripped. So that's the context. And just to understand that, the reason is our stock market's very small. The number of investors that we've got is actually quite small. And so to run any kind of a product, whether you're running a unit trust, an index tracker, a platform, etc., you need a large amount of assets to be able to spread the costs of running that stuff across a large number of investors. When you've got a small number of investors, they have to subsidize the costs. And the regulatory environment in South Africa, we've discussed in another show, is very good. So disclosure is very good. EAC is great. The auditing is very good. The custodians, all of that stuff is very good, but it doesn't come for free. And so just understand that because our market's small, we can't compare ourselves to the costs of an American market. We have to compare our costs to a very small market. And I think we are well priced relative to the rest of the world. I agree with you. I think if you're paying an actively managed fund, through 3% just for a fund cost, sure, you need to go and just do a proper deep dive into those costs. I mean, it might be that they've got the world's greatest sort of performance fee structure where they don't charge you anything if they just achieve benchmark, and they kind of give you money back if they're losing money, all those kinds of things. There might be a reason why 3% could be a good one, but if it's a flat fee and you're paying the same amount every year and it's 3% just for a fund, I don't know. I might put people I really don't like in there, but I don't think I'd put anyone I like. Well, I certainly wouldn't put my own money into something.
Yes. Yeah. And if you go look at those investment calculators, a 1% difference doesn't sound like a lot, but over 20, 30, 40 years, if you're still young, that could mean hundreds of thousands, if not millions of rand. So you have to understand the fees that you pay, scrutinize them, and at least get full transparency as to, okay, so why am I paying this fee? Am I really getting, you're going to pay more for something, you should get a better benefit than something that's low cost. That's just how it works. And, one way to benchmark that is to say, okay, so if this fund manager is charging more, I want to see that he was able to give those better returns. And 1 year is not enough to see. Because every year you'll kind of hear the best performing fund managers over the last year. I always question, was it skill or was it luck? Because it could just be luck.
Over 1 year? No, the answer is luck.
Yeah.
1 year, it's luck.
If it's a 1 year, it's just too short. So maybe look over 5 years or 10 years. What was the track record against maybe like a passive fund? And it's not always, there's nothing like the best performing fund in the world. It doesn't exist. It's what's best for your specific goal that you invested towards, and keeping fees reasonably priced. You don't want to be ripped off, because that also happens. But I agree. In South Africa, the regulatory environment is very strict and strong. So that also comes at a cost. That's kind of like the overheads to run anything is expensive. And if you have more investors in a fund, that dilutes those fixed costs and it makes it more affordable. So yes, in a passive environment, South Africa, 0.3, 0.4% is probably the lowest that you can go for a very basic passive fund. So now let's move on to the next fee. I think let's talk about platform fees, and that's one that we briefly mentioned in the previous episode. This is now when you buy a fund, you have to keep it somewhere. This is now the platform that you invest in, and there are two different types of platform fees that I've seen. You get your linked investment service providers, your LISPs, which is basically like one of the bigger names that you're probably aware of, where you give your money to them, they will keep it on their platform, not necessarily on the platform, it's usually in a custodial account with another provider, but they then administer this whole thing. So they help you if you want to change debit orders, make withdrawals, make deposits, give you tax certificates, keep your money safe, and give you access to actually buying these funds. But that also comes at a cost because, again, there's a company behind that, there's employees that needs to be paid, there's infrastructure that costs money. And on the list platforms, mostly what I've seen is if you start out at zero, it's probably going to be like a 0.5 to 0.6% inclusive of VAT.
Zero of investment. So
Yes. So just on the platform side, so 0.5 to 0.6. And then usually what it happens is they've got a tiered pricing. So the more money you keep on the platform, the lower the fee becomes, because again, it's economies of scale. And that could go quite low sometimes. If you have a lot of wealth invested, I don't know what the lowest you've seen there, but it can really get quite low. Some platforms have a fixed fee, actually like a family-based pricing, that if you hit a certain amount of investments on the platform, they just charge a fixed fee and it's not a percentage anymore, which can become quite cost-effective if you have a large portfolio. And then you also get brokerage platforms, which is your investment platforms that doesn't charge an annual kind of like admin fee. That's a percentage base. It's more so every time you buy or sell ETF or a share, they have like a 0.35% fee attached to that. And then there's also like other smaller taxes fees that's involved with that. So typically those brokerage platforms seems cheaper at front because it looks lower than the annual platform fee. But I'll caution you on that, because if you buy and sell a lot of times on those platforms, every time you buy and sell, that's at 0.35, 0.3, and then they can become very expensive. And that's usually how those companies make money. They try to incentivize buying and selling the whole time, because then every time there's a transaction, they make a fee. So they can actually become quite much more expensive. So that's kind of in the platform fee space in what I've seen.
Yeah, I think. I think well said, and maybe just that you would look at platforms again in South Africa and platforms globally. So in South Africa, starting at that 0.5 or 0.6 level, dropping down, you probably will get to 0.2 would be a phenomenal fee, but that would be because you've got tens of millions of rands on a platform. Globally, I think the very good platforms might get you at about 0.1 to 0.2. Again, they're much bigger.
Yeah.
So they give you some scale there. And I think I can't agree more. I wish I could disagree, but I don't like platforms that charge you zero for admin on an annual basis, because it costs an enormous amount to run an admin engine. Yeah. So if you're only charging as a platform, if you're only charging your clients when they transact, your incentive is to make them transact. They're going to be messaging you. They're going to be creating content for you to trade. They're going to tell you about the latest, greatest fad. And all of those things are designed to get you to be active. And what you need to understand about investing is it should be pretty inactive. You should have a very good strategy. You should be buying because you've got new cash flow and you want to invest. You shouldn't be trading because some videos come along. Even this video, if you're watching this and we say something, don't go and buy just because we said something. Go and buy because it fits your long-term strategy. And so, if your platform is working against you by telling you to buy and sell the latest fashion, and that's what it is, then you're in the wrong place and you should move your money elsewhere.
And one thing around the brokerage platforms, especially on the international space, which is for South Africans to invest offshore as a DIY investor, your options are very limited. And There's a whole can of worms that I can open up now. But one thing that I want to comment on is tax reporting. If it's a local South African company, tax reporting is much better because they communicate to SARS and they send you your statements, and every year your tax, you should be tax compliant, at least on the investment side. But as soon as you move overseas and you use one of the independent kind of like international brokerage platforms, they usually don't speak of SARS. So it is your responsibility to report on your taxes, and they don't give you a nice laid out tax statement. You have to go and you and your accountant has to calculate the taxes that you pay. So yes, you save on fees usually, but remember again what I said earlier. It's probably going to cost you more time later on to do the actual admin stuff. So just be aware that if you compare platforms, fee is important, but it's more so the service that you get. Because not all platforms are created equally. And
No.
we're not going to not going to name any names, but some platforms may be a little bit more expensive, but they've got excellent customer service, and you just know you put your trust with them, you'll be fine, and it's not going to cause you problems later on. That's going to cost you time to try and resolve.
No, and I agree with you. I mean, I don't think there's a platform sitting in in Germany or in the UK that has a straight line to the Commissioner of SARS's email address or phone number. They're not going to help you when you say, "Hey, I need my tax stuff for the end of February." They're going to just give you a data dump, and it's up to you to go.
Yeah.
So you've got to be careful of that.
Yes. And then the next one is advisor fees, and this is one that I think came under the spotlight a lot in the recent years, as opposed to when we kind of the movement around low cost passive index DIY space has evolved. A lot of people kind of question the advisor fee that I see in circles that I walk around. Now, advisor can charge up to 1%, and inclusive of that, 1.15% of the portfolio that you have invested with them. It's called the assets under management fee. That's one way that an advisor earns fees. There's other ways as well, but we're going to specifically talk on that today. So yes, this is the reason the 1% fee over the long term could have effect on your investments. But what I want you to do is go and take that 1% on your investment portfolio and look at how much you have actually invested with the advisor, and then go and look at the rand value. Go do this calculation. Say, okay, I am paying Mr. Advisor this amount per month, this amount per year. Then what value am I getting for that? Because I'm going to start off by saying financial advisors are not fund managers. They're not asset managers. They shouldn't be synonymous with I'm giving you the best fund, because they just most likely picking a fund that's managed by someone else, a fund manager. So yes, that is one of the values that an advisor can add, is helping you create an investment portfolio and choosing maybe funds that aligns with your goals. That's true. But I think the true value of a financial advisor is helping you manage emotions. Because putting a portfolio together is not that difficult, but keeping with the plan, I think that's really where the value shines through. When there's a market downturn and we all panic and we want to sell off our investments because we don't understand what's going on, having a gatekeeper there to tell you, no, we've got a plan, we're going to stick to the plan, just stay put. And I'm talking from personal experience, because when I started my own investment journey, I shared this before, it was in 2020 when I graduated. I had like a little bit of student savings saved up, and I entered the market in January, and then March hit COVID, 30% drop in markets. And I was one of those that wanted to sell. I was like, no, this whole thing, what's going on here? And luckily I had someone at that point who told me, no, you're going to skip it. We're not going to make any changes. I'm very thankful for that. So advisor could also add value beyond investments. They can help with tax planning, estate planning, insurances, all of that. So yes, understand the fee. If you're using an advisor, understand the fee that you are paying in rand terms, and then look at the value. If you're paying a fee and you haven't heard from Mr. Advisor for 5 years, then absolutely you should get someone else, because they're just
not your advisor. Yeah,
they're not your advisor. You're just a customer. You're not a client. So yes, that is important. But truly understand what you're paying and what value are you receiving, and then you can make an informed decision as to, is that fee reasonable for you or not.
You can see. I can see this is another topic close to your heart. So I mean, to me, to call a spade, I think there are some rubbish advisors out there that aren't worth the money they're paid, even if they get paid 10 rand a year. But there are some brilliant advisors that are pretty bad at communicating the value that they're adding. And so it is a very good conversation to have with your advisor to say, okay, so I mean, you should try and do it before the time. Don't try and, I mean, there's never a bad time to talk about fees, but if you've engaged an advisor, have a proper conversation about what is it that we do? What do you expect from me? What do I expect from you? And how does the money work? And no one should be ashamed or embarrassed to talk about money. I know advisors, good advisors. I'm the same in terms of getting irritated if I have the same conversation with the same first person about fees every 6 months or every year. The likelihood is we're going to end our relationship, because I'm very happy to have a deep conversation about money and about what I charge and what value I add, but not repetitively. Then I just feel like you're wasting your time and mine, and let's part company. But a great advisor, I think your comment is right. They're actually brilliant coaches. Even if you're pretty financially sophisticated, there is a time when you need an outside voice that just becomes your anchor and your stabilizer to say, let's question why you're thinking about doing something, why you're making a change, and let's review that against your goals, and off we go. But if your financial planner is saying to you, listen, I can choose the next 5 unit trusts that are going to change the world, they're either lying or they're deluding themselves and you, and that's just, you can't do it. No one can do it. So I think they're a very good coach. They should help you with goal setting. They should help you develop a good strategy. Most importantly, when times are hard, you should have enough trust in each other that they're going to get you through those times. And sometimes it's a case of saying no. I mean, it's a hard conversation, but sometimes it's also a case of just reminding you that this is where you are, and that the plan was for a bad time to happen. Unfortunately, the bad time happened 3 months later or 3 years later. Who knows? But preparing for that and then coaching you through it is the game. And I think investment success is achieved over decades, and you can't be successful over decades if you're out of the market, if you're not invested. And that's what a great advisor should do for you. And if you don't have a great advisor, don't pay them. Fire them. Get someone else or do it yourself. No problem. We're not saying, and I think I'm not saying that you have to do it with an advisor or you have to do it on your own. What we're saying is pay value and then appreciate the value, or do it yourself. And you think you can do a better job. There are people out there that can do it themselves.
Yeah,
they're few, but they can.
Yes, and one more thing that I think the value that I've experienced is accountability. Is to say we've got a plan, we follow through with the plan, and keeping you up to date and accountable to the agreed actions. Because sometimes the biggest mistake we make is not doing anything at all. It's inertia. It's kind of like analysis paralysis, and we don't do anything because we're not sure what the right decision is. And having a thinking partner to help you coach through the options and then helping you make an informed decision. You may not see the value immediately, but that could mean a massive difference over many decades. So if you do work with an advisor, they should earn a fee. Absolutely. You should not expect someone to jump through hoops for you if you're not paying them anything or very little. So also know that, but choose someone that really adds value to your life and that makes the whole investing world easier and more simplified for you, and pay them well.
I'm going to steal your phrase. I like that. Thinking partner. I like that. Well done. We're getting short of time, and we've got your favorite category of costs to talk about.
Yes, that other one is so well defined. What is other? If you now down, and I'm sure there's listeners going to see this, you download your EAC statement and you see your total cost being something like north of 3%, 5%, 10%. I've seen horrible things like
27 or 25 or something. Yeah.
In totality, it's usually that other fee. So what does that mean? If you look at the old generation types of usually retirement annuities that are issued through life insurance contracts, what happens if when that investment is sold to you, there's commission baked into the investment that was paid to the advisor or the broker that sold it. And there's also a lot of marketing fees built into it. So if you get your statement, and what's happening is you kind of take a contract out of the company when you open your investment. And if you want to move it across, there's a penalty fee, an early exit penalty fee that they recoup from your investments. And that's what you'll see there. And that sometimes means it's like a large amount of what you've invested, which is a very unfortunate thing, because I don't think it should be the investors, at their detriment if they want to move from a company because they're not happy with the service. And I'll caution you on those types of investments. Personally, that's just my opinion. I don't think those investments are designed for long-term success. I think the reason behind that is because you're in a contract, it will keep you committed to that debit order to continue with the with the investment, and at the end you get a reward. So that's my understanding of why they exist. But sometimes if you want to move to a low-cost provider, you're going to hit with a big penalty. And if you compare the cost of moving against the lower cost at another platform, and you project that over many years, it's usually more cost-effective to move. But I'm not saying it is always. Sometimes the penalty is just too high and you have to keep invested. I would rather just, before you take out any investment, always ask, and you should be provided for a quote in any case that reflects the effective annual cost. And if you see anything north of 3%, I would definitely question why the fee is that high.
Yeah, and you shouldn't really be paying big upfront fees on an investment. It eroding your capital before you've even started. So I think paying fees on to use the cell phone language, on a pay-as-you-go basis makes sense. You're in it and you pay as you go along. But you're to be locked into a contract always makes me uncomfortable, and especially where you're locked into a contract and they're charging you a big upfront fee that they then tell you spread out over 20 or 50 years. And I just don't like them. It always makes me feel nauseous to see those costs, and I just know that we're paying for very big head offices and fancy marketing and boxes at the sport and all those kinds of things, big TV campaigns and all of that stuff for me is garbage. And especially when they try and tell you that, look, this fee it says 17.2, but if you go shopping here and you add these 17 other very expensive products to this thing, this fee is going to come down. It'll only be 12%. I mean, it's rubbish. Like, I think you pay investment fees for investments, you pay insurance fees for insurance, and you understand what those are. And the moment they blend them and they blur them, you actually don't know what you're paying. And especially where you've got to now go and shop, do this, do that. Damn, like go and get healthy, go and eat healthy, and pay appropriate investment fees. Don't think that these things are working in your favor. They're not. I mean, the moment you're on the other side of a negotiation with actuaries, lawyers, psychologists, and accountants, you know that you've got difficulty. So I think transparency is good. And I mean, maybe just to summarize from my perspective, an EAC, 2.5% to 3%. If you're paying a good advisor as well, I don't mind that. I think obviously we would all like the fees to be as low as possible, but I mean, Pieter's made the point very well that you've got to get good value for what you're paying, but then you are getting value. That's the whole point. The moment you're over 3%, you got to ask some serious questions as to why that's the case. There might be the odd situation where it's applicable. You're seeing 15%. I mean, just do something else with your money. You can do much better.
Yeah. And that opportunity cost, that's always what catches me, because I've had conversations around this a lot of times where they say, yeah, but you get the bonus or a reward at the end of the journey. Maybe so, but the opportunity cost of paying high fees in the beginning of funds that could have been invested, projected over a long period of time, that's a massive fee that's hidden that you don't even know about. So yes, I think you summed it up excellently. If you use an advisor, 2.5 to 3% in totality is usually reasonable. You go on it your own, you can go as low as less than 1% if you choose a passive fund on a low-cost platform, maybe a brokerage platform. And given that you're not going to buy and sell every day, but fees is important. Yes, scrutinize them, but understand that you have to pay for value. And as long as there's that transparency and that transaction that you understand, okay, I'm getting more value than what I'm paying for, then, it's good. You've done well. But you need to have transparency. Because I think a lot of people don't even know what fees they're paying. So if by the end of today you at least downloaded a statement and you looked at your fees, I'll be happy, because then at least you've got awareness. And that's where the journey starts.
100%. Thank you so much for watching, and please keep giving us your comments. We appreciate them. Please send us your questions, and don't forget to subscribe.
Yeah, thank you so much. See you next time.
The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.